Hey guys, welcome back to another episode. In this video we will be going through our very simple, yet profitable MACD relative vigor index trading strategy. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. What is the MACD indicator? The MACD, or Moving Average Convergence Divergence Indicator, is a momentum oscillator used to trade trends. MACD plots the distance between moving averages and helps traders identify trend direction and whether the bullish or bearish momentum in the price is strengthening or weakening. Although MACD is an oscillator, it is not typically used to identify overbought or oversold conditions. The MACD is a trend-following indicator since its purpose is to show the differences between two moving averages. The difference between the two moving averages is plotted as one line, and the second line plots a smooth version of the first line. These two lines appear on a chart as a technical indicator and oscillate without boundaries. The crossover of the two lines gives trading signals similar to a moving average crossover system. When the MACD crosses above the signal line, an uptrend may be emerging. Conversely, when it falls below the signal line, a downtrend may be emerging. The difference between the MACD and signal values is plotted as a histogram, which may sometimes give you an early sign that a crossover is about to happen. How does MACD work? The MACD indicator works using three components. First, the MACD line. Second, the signal line. Third, the MACD histogram. The first line, or the MACD line, is the difference between two moving averages, usually the 12-period EMA and 26-period EMA. The second line, the signal line, is the moving average of the first line. Usually, a 9-period EMA. Said differently, it's the moving average of the MACD. This means that the MACD line is considered the faster line, while the signal line is considered the slower line. If the two lines come together, they are said to be converging. And if they move away from each other, they are diverging. The difference between the two lines is represented on the histogram. If the MACD histogram is plotted above the zero line, this signals an uptrend. If the MACD histogram is plotted below the zero line, this signals a downtrend. How to trade MACD? There are four common MACD trading strategies. First, zero crosses. When the MACD crosses above zero, this is considered bullish. When the MACD crosses below zero, this is considered bearish. On this chart, the signal line and histogram are removed to make the example clearer. Some traders also like to watch the signal line as well and look for it to cross above and below zero to generate trading signals. Second, MACD signal line crossovers. Like with most crossover strategies, a buy signal comes when the faster line crosses above the slower line. And vice versa for a sell signal when the faster line crosses below the slower line. Here, the MACD line is the faster line, while the signal line is the slower line. Third, histogram reversals. The histogram represents the difference between the MACD and signal line. This means that as the bars on the histogram move further away from zero, the two lines are moving further apart. When the price's momentum is strong, the histogram will increase in height. When the histogram shrinks, it is a sign that the momentum, whether bullish or bearish, is weakening. Once the initial momentum surge is over, a mound or hump shape will emerge. This is a signal that the moving averages are tightening again, which can be an early sign that a crossover is about to happen. Fourth, MACD divergence. The divergence between the MACD and the price is a strong signal. When price makes a lower low or higher high, MACD should also make a lower low or higher high. Both should move in the same direction. But when it doesn't, there is divergence. In this example, the price made a lower low, but MACD made a higher low. This divergence between price and MACD signals a possible trend change. Think of the MACD divergence as an early warning sign for trend reversals, or at least, choppy market conditions ahead. What is the most common problem with MACD trade signals? A common problem with MACD trade signals is their lag time, especially when price spikes. Profitable MACD trading strategy. Now that we understand the basics of the MACD indicator, let's dive into simple strategy you can test out. We've decided to take the approach of using less popular indicators for this strategy to see if we can uncover some hidden gems. Feel free to stress test of this strategy to see how it works with your trading style. MACD Relative Vigor Index Trading Strategy. What is the Relative Vigor Index or RVI? The Relative Vigor Index or RVI is a momentum indicator used in technical analysis that measures the strength of a trend by comparing a security's closing price to its trading range while smoothing the results using a simple moving average or SMA. The RVI's usefulness is based on the observed tendency for prices to close higher than they open during uptrends and to close lower than they open in downtrends. The two most popular RVI trading signals. First, RVI divergences. Divergence between the RVI indicator and price suggests there will be a near-term change in the trend in the direction of the RVI's trend. So, if a security price is rising and the RVI indicator is falling, it predicts the security's price will reverse over the near term. Second, RVI crossovers. Like many oscillators, the RVI has a signal line that's often calculated with price inputs. A crossover above the signal line is a bullish indicator, while a crossover below the signal line is a bearish indicator. These crossovers are designed to be leading indicators of future price direction. And now, why the MACD Relative Vigor Index trading strategy? The basic idea behind combining these two tools is to match crossovers. In other words, if one of the indicators has a cross, we wait for a cross in the same direction by the other indicator. When this happens, we buy or sell the equity. Long trade setup. First, the MACD line crosses above its signal line. Second, the RVI line crosses above its signal line. Exit rules. We hold until the MACD line crosses below its signal line. Short trade setup. First, the MACD line crosses below its signal line. Second, the RVI line crosses below its signal line. Exit rules. To manage the position, we hold until the MACD line crosses above its signal line. I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Here are other examples of the MACD Relative Vigor Index trading strategy. The MACD is an ingenious invention because it turns the disadvantage of moving averages into a practical trading tactic. Feel free to stress test of this MACD Relative Vigor Index strategy to see how it works with your trading style. As always, if you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.